Hi, everybody. Welcome to Stop Being Sold, a community of informed consumers who are sick and tired of being sold financial products they don't understand or need. So if you're tired of being a transaction, please hit that notification bell and also the subscribe button so you never miss another video from us. How are you today, Brian?
Hey, Michelle, I'm doing great. How about yourself?
Good. Thank you so much. So today's topic, we're going to talk about how financial advisors get paid.
Oh,
Brian,
good one. Good one.
right? Well, I'm sure you are you're a financial advisor, been doing this for 24 years.
24 years. Yeah.
You've been asked this question more than you would like to admit. And also it's a question that we get asked at Stop Being Sold. So we're going to dive in, but I'm going to start it out. How financial advisors are paid varies on the types of license that they, like how they're licensed,
Right.
and in what capacity they operate. Correct?
Yeah, that's true, Michelle. There's three main ways that financial advisors are paid today, and we'll break them down. But the three are: they either charge a fee, they earn commissions, or they're on salary. It's that simple.
Okay. All right. Well, let's start with fee.
Yeah, let's start with the fees. That seems to be the most common one. So if an advisor today, like myself, charges fees, they usually fall into these categories. Okay, so they'll either charge AUM fees, which is assets under management. And this is a type of fee, Michelle, that an advisor charge. It again stands for assets under management, but its common fee that you hear is 1%. 1% annually of the assets being managed. You'll see this quite often with a lot of advisors. And Michelle, these fees are usually paid on a quarterly basis, and sometimes they have a graded scale to them, which means you'll pay a lower percentage with higher amounts of assets that are actually being managed. So, for example, you might have an advisor that charges a 1% in fees for up to 500,000 in assets. Anything over 500,000 up to $1 million, they reduce the fee down to like 75 basis points. So 0.75%. And then sometimes you'll see them go one step further and they only charge you 0.5% for all assets over $1 million. So that's how assets under management work in a fee-based advisor.
Okay.
Second avenue with a fee-based advisor, you might see them charged a fixed rate or an hourly rate. It's usually found in advisors that don't charge for AUM. They may charge you a flat fee like, okay, Michelle, we're going to, for $500 a year, you can call in, we'll give you some advice on your plan, okay? Or other ones may charge you by the hour. So like $250 an hour for every hour that they actually work for you. And under the fee section, the third avenue is they may charge you a fee for financial planning.
Okay.
This, again, is a common practice. Some of them will charge a declared fee. So they could range from $100 to several $1,000s, depending on the complexity of the plan. And then you'll see also, Michelle, in this area, you'll also see some of these advisors charge you for a financial planning fee, but they may also charge you an assets under management fee.
Okay.
So again, it's all understanding what's in the contract that you're signing with a fee-based advisor.
Again, always go back to the contract, right?
Go back to the contract.
Read the contract. All right. So that was the first way they get the fees. First way as financial advisors get paid. The second one is commissions.
Commissions. It depends on the type of advisor and how they're licensed. They could charge you a commission, right? And here's a couple of different ways. So think about insurance products. You usually understand that insurance products pay the advisor commission, and that advisor doesn't charge you, the consumer, for that. So if they're selling you like an annuity or an insurance products like life insurance or long-term care, them are commission-based products in the insurance world. But then when you go over to the investment side, you're thinking, well, they're not charging me no fee. How are they doing these mutual funds without charging me a fee? Well, mutual funds being sold by advisors, advisors get paid a commission on them. And depending on the type and class of that mutual fund. For example, let's break this down. Like Class A mutual funds are front end loaded, meaning you pay the fee up front. So here's an example. You have a $100,000 or $1,000 investment into these, could charge you 5.75% up front, or $57.50 in this example. Now on that $1,000, you think, oh, my $1,000 is getting invested. No, the fee gets subtracted.
Taken out of it.
$942.50 gets invested into that fund that you're trying to buy.
Okay.
They have lower ongoing fees and like 12B1 fees and annual expenses. Now,
So did you say that they can, many Class A mutual funds can charge up to 5.75%?
Up to 5.75% is the average. We've seen them as high as 8%. So,
okay. Got
so
it.
it just depends, but a good normal range is up to 5.75%, and it'll be declared also. So just ask them if they're selling mutual funds, and you'll see on your, so if someone's offering you a mutual fund, so the mutual fund might be let's see, SBG AX, and that used to be the old Smith Barney mutual funds Class A share, and so you see the A in there. So just look for stuff like that, and you'll stay on your statement what type of fund it is, if it's A share, B share, C share. So, but that's how A shares work. Now B shares do not have an upfront fee. You're thinking, oh, that's the better deal, but fine print, they have a back-ended sales load, which is, it's sometimes referred to as a contingent deferred sales charge, or CDSC. You don't pay this unless you sell your shares before a specified time. Kind of reminds you like an annuity, right? With an early surrender charge. Some of these can be up to 7 years. They also have higher 12B1 fees than Class A mutual funds. That's ongoing fees. So again, understand the difference of the mutual funds that you're buying. That's how that advisor gets paid. A third one we see, Michelle, is Class C mutual funds. They usually don't have an upfront fee. They do have the highest ongoing fees and annual expenses. Now, if I see, and it's funny, Michelle, over the years, I have reviewed thousands and thousands of statements, of mutual fund statements, annuity statements, whatever it may be. When I see mutual fund statements and it is just loaded with Class C mutual funds, it kind of drives me nuts, because I know that, yeah, there's no fee up front, but you're paying sometimes up to 4 times the ongoing fee. And it's subtracted right out of the account.
So it looks good. It looks good up front.
Looks good up front.
But you're going to pay for it on the backside.
Right. And if you're not sure what you're paying, below this video here, we put a FINRA's mutual fund analyzer chart. It'll actually type in your mutual fund from your statement, and it'll show you exactly what the shares are, what fees you're paying annually, upfront fees, ongoing expenses, and see how high that is in comparison to other mutual funds. So that's the second one.
So the third one, salary.
Salary. Some advisors actually still receive a salary, Michelle, and possibly a bonus based on the amount of products that they actually sell you. So you may see these advisors working for a big brokerage firm, or maybe even at your local bank.
Local bank,
and, it's funny. I got a little story to tell you about the bank salary employee. So. You know, we've talked about in several of the videos about it all depends on how the advisor is licensed, the products that you receive from them, right? Well, when you think of bank products, what do you think of as far as the guarantee?
FDIC.
FDIC. So imagine that you, as a bank employee, if you've got a consumer that's coming in that they want to buy an annuity, because you've already pre-sold them on an annuity versus the stock market or versus a CD, and you come in and usually have them little plaques on their desk when you sit down with them, and it says FDIC insured. It looks good. It sounds great. You love it. Imagine the employee that has to take that FDIC plaque off their desk and stick it in their drawer for every time you come in, because that's not allowed to be on there because it's not an FDIC insured product.
The annuity, using this
The
annuity.
annuity is it.
Okay.
So I had a friend that had to do that and
Jeez.
got paid a salary for selling annuities and was the #1 annuity producer at this major bank in a year. And it's like, there's a lot of annuities that weren't FDIC insured that you promoted through the bank. It's kind of funny. So
Interesting.
just understand that salaries, commissions, and fees.
Okay. All right. So one thing that we've talked, and we'll put the link below in this video, the difference between a suitability advisor and a fiduciary advisor.
Yes.
And that when you ask an advisor, how are you paid? A fiduciary has to, by law, tell you in clear terms exactly how he or she is compensated.
You're exactly right.
Does a suitability advisor?
No. And it only, remember, with this suitability side of it, Michelle, they only have to find a product that's suitable for you. Mm-hmm. And let's put it this way. If you asked me today, and I was a fiduciary advisor, of course, you know I am, I have to declare that, yes, I get paid a fee for managing your assets. Right. If you asked me today and I was a suitability advisor and I didn't answer, and I steered away from the question or responded with something that wasn't the answer you was looking for, run. It's that simple. You don't need to be working with that type of an advisor. Honestly, this is about your money, and feel good about it that you're working with the right person. So.
Got it. And so what happens if someone, you're talking about suitability, or just anybody saying, well, steering you away or giving you an answer or something along the lines like, my company pays me so you don't have to, is that to me doesn't answer the question, actually.
It doesn't answer the question, and it could go two ways. If they tell you that, they're either being paid a commission on the products that they sell. So if they have insurance products, you know they're getting a commission for it. And the other option, again, if you're in a big bank or a big brokerage firm, and they say, my company pays me, you don't have to, they're getting a salary. You'll usually only see that in the banking industry, though. So.
Okay. Got it. All right. Well, thank you so much for this. Is there anything else we need to know about how financial advisors are paid?
Well, the biggest thing is, just be careful out there. And remember, if you don't feel good, walk away from it. It's that simple. If the contract and the terms don't look good and the advisor's not answering your question as far as what they're getting paid and how they get paid, that's a red flag right up front. Be careful.
Sure.
Is there judgment being clouded by commissions? Chances are yes.
Yeah. Well, I mean, it just boils down to, it's your money. It's your financial future. It's yours. You might as well be working with someone who's very clear, who's very transparent, and who also legally has to and ethically has to have your best interest. Act on your best interest, which is what a fiduciary does. So.
It is. And think about this, just a quick follow-up, relationship. Right. It's about the relationship. It's a two-way street. You've got to feel good about working with them. They've got to feel good about working with you. If Michelle, if you were coming to me as a client today, my goal is to make sure that you're a great fit for our firm, number one. Mm-hmm. And number two, that my firm could actually provide value to you. Right. And if we can, there's where the relationship begins, and never get steered the opposite direction when asking questions. If you're not getting a straight answer, walk away. It's that simple.
Great advice. And thank you for this information. If you like this video, hit that like button, that thumbs up button there. It helps us grow the channel and also lets us know that you're enjoying the content we're producing. And don't forget to subscribe and hit the notification bell. You have to hit the notification bell if you want to be notified every time we post videos. Thank you so much, Brian, for this. And thank you, everyone who's been watching.
Thanks, Michelle. Thanks, everyone. Have a great day.